We need to go back to 1967 for a moment. A small group of investors in Cleveland, Ohio, are sitting around a table, staring at a legal document that would fundamentally change how ordinary people could own real estate. Before this moment, if you wanted to invest in commercial property, you needed to be wealthy. You needed connections. You needed millions of dollars just to get a seat at the table. But these investors had figured out something that the wealthy had been keeping to themselves for generations. They discovered a legal structure that would let average Americans own pieces of shopping centers, office buildings, and apartment complexes for the price of a single stock share. And here's what makes this fascinating. The wealthy fought against this for years. They lobbied Congress. They tried to bury the legislation because they understood something that most people still don't fully grasp today. By the end of this video, you'll understand the exact mathematical framework that real estate investment trusts use to generate wealth, and why 3 specific REITs right now are positioned to potentially turn $10,000 into a portfolio worth several $100,000 over the next 2 decades. So let me show you exactly how this works, starting with that pivotal moment in the late 60s when everything changed. My name is Tom, and I spend way too much time thinking about money and psychology. If you're someone who wants to build real wealth through proven, boring, disciplined investing rather than chasing lottery tickets or listening to another guru promise overnight riches, subscribe and like this video. It actually helps more than you think. Now, let me take you back to understand why REITs even exist in the first place, because this context matters more than most people realize. In 1960, President Eisenhower signed something called the Real Estate Investment Trust Act. On paper, it seemed simple enough. It allowed companies that owned real estate to pass income directly to shareholders without being taxed at the corporate level, as long as they distributed at least 90% of their taxable income as dividends. But here's what most people don't understand about this moment. This wasn't charity. This wasn't the government suddenly deciding to help regular folks build wealth. This was actually a response to something that had been happening for decades in the shadows. You see, wealthy families had been using private real estate trusts since the 1800s. The Astors, the Vanderbilts, families whose names you'd recognize. They pooled their capital, bought massive properties, collected rent, and passed that wealth down through generations. The average person couldn't participate because these trusts required minimum investments that would be equivalent to several $1 million today. The 1960 Act was supposed to democratize this. But here's the catch. For the first 20 years, almost nobody used it. Why? Because Wall Street didn't want them to succeed. The big investment banks made their money on complex deals, private placements, insider transactions, a simple, transparent investment vehicle that anyone could buy threatened their entire business model. So REITs languished in obscurity through the 60s, 70s, and most of the 80s. They were treated as boring, unsophisticated, something for people who didn't know how to play the real game. But then something happened that changed everything forever. Let me tell you about what happened to commercial real estate in the late 80s. The savings and loan crisis had just devastated the banking sector. Over 1,000 banks failed between 1986 and 1995. Property values collapsed. Developers who had borrowed heavily during the boom years suddenly found themselves underwater on billions of dollars worth of projects. Office buildings sat empty. Shopping centers defaulted on their loans. The Resolution Trust Corporation, which was basically a government agency created to clean up the mess, found itself holding over $400 billion worth of distressed real estate assets. Now you might be thinking, what does a banking crisis from 35 years ago have to do with investing $10,000 in REITs today? Everything. Because this crisis created the modern REIT industry. Here's what happened. Large institutional investors saw an opportunity. They could buy premium real estate assets from the government at pennies on the dollar, but they needed a vehicle to hold these assets and attract capital from smaller investors. REITs, which had been collecting dust since 1960, suddenly became incredibly attractive. Between 1991 and 1994, the total market capitalization of publicly traded REITs exploded from about $9 billion to over $45 billion. Properties that banks had foreclosed on were being packaged into REIT portfolios and sold to regular investors who could now own a piece of Class A office space in Manhattan or a regional mall in Texas for the cost of a few shares. And here's where it gets really interesting. The people who got in early during this period, the ones who understood what was happening while everyone else was still traumatized by the real estate collapse, those investors saw returns that seem almost impossible today. Some REITs from that era delivered total returns exceeding 2,000% over the following 3 decades. 2,000%. That means $10,000 would have become over $200,000 plus decades of dividend payments along the way. But here's the catch that nobody talks about. Not all REITs performed equally. In fact, some REITs from that era went bankrupt. Some dramatically underperformed the broader market. Some were revealed to be poorly managed vehicles that enriched executives while destroying shareholder value. The difference between building generational wealth and losing your shirt came down to understanding which types of REITs had genuine competitive advantages and which were just marketing vehicles for mediocre real estate. So what's the pattern? What separates the winners from the losers? And how does this apply to where we are today in 2024? Let me give you an analogy that makes this concrete. Imagine you're considering opening a franchise restaurant. You've got $200,000 to invest, and you're looking at 2 different opportunities. The first opportunity is a fast food burger chain. You know the model: high volume, low margins, completely dependent on location and foot traffic. When the economy is good, people buy burgers. When the economy struggles, they cook at home. Your success depends almost entirely on factors outside your control. Traffic patterns, competing restaurants opening nearby, whether the highway exit ramp gets redesigned. The second opportunity is completely different. It's a medical office building next to a hospital. Your tenants are doctors' practices, imaging centers, physical therapy clinics. These businesses sign long-term leases, often 10 to 15 years. They spend hundreds of thousands of dollars customizing their spaces with medical equipment. They're not going to leave because a competitor offers lower rent down the street. Their patients come to them regardless of economic conditions because people get sick in recessions too. And here's the kicker. Healthcare spending in America has increased every single year for over 60 years straight. Even during the 2008 financial crisis, healthcare spending grew by 4.4%. Now you might think, obviously I'd choose the medical office building. And you'd be right. But here's what's fascinating. Most REIT investors don't apply this same logic. They chase the highest current dividend yield without considering the underlying quality of the real estate, the stability of the tenants, or the long-term trajectory of the sector. This is where most people go wrong. And this is exactly why I want to walk you through 3 specific REITs that I believe represent the best combination of current income, growth potential, and sector positioning available today. But before I reveal them, I need to tell you about the antagonists in this story. Because there are people who absolutely do not want you to understand what I'm about to explain. Wall Street has a dirty little secret when it comes to REITs. The big institutional investors, the pension funds, the endowments, they love REITs. They've been quietly accumulating positions in high-quality REITs for decades, but they don't want retail investors competing with them for shares. Why? Because more buyers mean higher prices, which means lower dividend yields, which means less attractive entry points for their massive capital pools. So what do? 3 specific tactics. First, they publish research reports that make REIT investing seem more complicated than it actually is. They throw around terms like funds from operations, net asset value spreads, cap rate compression, implied capitalization rates. All of this jargon serves one purpose: to make regular investors feel like they're not sophisticated enough to analyze these investments themselves. The truth? The core metrics you need to understand are dividend yield, dividend growth rate, and funds from operations growth. That's it. Everything else is window dressing. Second, they push the narrative that REITs are dangerous because of interest rate sensitivity. You've probably heard this talking point 1,000 times. When interest rates rise, REITs fall. This is technically true in the short term, but here's what they don't tell you. Over 10-year periods, the correlation between interest rates and REIT returns is actually quite low. What matters more is the underlying quality of the real estate and the growth of rental income. They want you scared of short-term volatility, so you sell your shares to them at discounted prices. Third, and this is the most insidious tactic, they promote the wrong REITs to retail investors. Watch any financial news channel during market hours. The REITs they discuss are almost always the most volatile, the most speculative, or the most likely to cut their dividends. They rarely feature the boring, consistent, high-quality REITs that actually build wealth over decades. Why? Because boring doesn't generate clicks, views, or trading commissions. So let me be clear about something. What I'm about to share with you are not the flashiest REITs. They're not the ones you'll see promoted on social media with rocket ship emojis. They're the REITs that institutional investors quietly accumulate while publicly dismissing them as boring. Let's get into the first one, Realty Income Corporation. The company's ticker symbol is O, which stands for something most companies would never be bold enough to claim. The O stands for monthly dividends. That's right. While most stocks and REITs pay quarterly dividends, Realty Income has built its entire brand around paying shareholders every single month. They've made over 650 consecutive monthly dividend payments since they went public in 1994. They've increased that dividend over 120 times. Let me say that again because it matters. Over 120 dividend increases in 30 years. Now you might be thinking, okay, but what do they actually own? This is where most people get surprised. Realty Income owns over 15,400 properties across all 50 US states: Puerto Rico, the United Kingdom, Spain, Italy, Ireland, Germany, France, and Portugal. These aren't apartment buildings or office towers. They're primarily retail properties, but not the kind you might think. They focus on what they call necessity-based retailers and service-oriented businesses. Think dollar stores, pharmacies, convenience stores, quick service restaurants, grocery stores, home improvement stores. Here's why this matters. These tenants sell things people need regardless of economic conditions. You're not going to stop buying groceries because the stock market dropped. You're not going to avoid the pharmacy because GDP growth slowed. And here's the genius part of their model. Realty Income uses what's called triple net leases. Under these agreements, the tenant, not Realty Income, is responsible for paying property taxes, insurance, and maintenance costs. Realty Income collects rent checks without worrying about a roof needing replacement or property taxes spiking. Let me break down the math on what happens if you invest $10,000 into Realty Income today. As of right now, Realty Income shares trade around $56, give or take depending on when you're watching this. The current dividend yield is approximately 5.5%. That means your $10,000 investment would generate about $550 in annual dividend income, or roughly $45 per month. But here's where it gets interesting. Realty Income has increased its dividend at an average compound annual growth rate of about 4.3% over the past 30 years. Now, past performance doesn't guarantee future results, and I want to be very clear about that. But let's model out a scenario where they continue growing dividends at even a more conservative 3.5% annually. After 10 years, your annual dividend income from that initial $10,000 investment would grow to approximately $775. After 20 years, it would approach $1,100. And this is just from the dividend growth. We haven't even talked about share price appreciation or reinvesting those dividends. If we assume modest share price appreciation of 4% annually, which is actually below Realty Income's historical average, your $10,000 investment would be worth approximately $22,000 after 20 years. Combined with the reinvested dividends growing at 3.5%, you're looking at a total portfolio value approaching $40,000 from that single $10,000 investment. But now you might think, okay, that sounds decent, but it's not going to make me rich. And you're absolutely right, which is why Realty Income is just one piece of this three-part strategy. Think of Realty Income as your bedrock. It's the stable foundation that's going to pay you increasing income month after month while you sleep. But we need higher growth engines to really accelerate wealth building. This is where it gets really interesting. The second REIT I want to discuss is Prologis, ticker symbol PLD. And this company represents something that most people don't fully appreciate yet. Prologis is the largest industrial real estate company in the world. They own and operate over 1.2 billion square feet of logistics facilities across 19 countries. To put that in perspective, that's roughly the equivalent of 24,000 football fields of warehouse space. Now, you might be wondering why warehouses are interesting. Here's the thing. We're living through the biggest transformation in retail and commerce since the invention of the shopping mall. E-commerce has fundamentally restructured how goods move from manufacturers to consumers. Every single thing you order online has to be stored somewhere before it reaches your doorstep. That somewhere is increasingly a Prologis facility. But here's what most investors miss about this story. It's not just about Amazon. Sure, Amazon is Prologis' largest tenant, but the real story is about the thousands of other companies racing to build out their logistics infrastructure. Traditional retailers like Walmart, Target, and Home Depot are spending billions to compete with Amazon's delivery speeds. They need modern warehouse facilities close to population centers. Auto manufacturers are stockpiling electric vehicle batteries. Pharmaceutical companies are building cold storage networks for specialized medications. Food companies are investing in refrigerated distribution centers. All of this benefits Prologis. And here's the kicker that most people don't understand. There's a massive shortage of modern logistics real estate in the most desirable locations. You can't just build a warehouse anywhere. You need to be near highways, ports, rail lines, and population centers. The land is limited. The zoning approvals take years. The construction costs have skyrocketed. This creates a situation economists call inelastic supply, which basically means Prologis can raise rents year after year because tenants have nowhere else to go. Let me show you what this looks like in numbers. Over the past decade, Prologis has grown its funds from operations, which is the REIT equivalent of earnings per share, at a compound annual rate of over 10%. Their dividend has grown at approximately 12% annually over the same period. This is almost triple the dividend growth rate of Realty income. Now, Prologis currently yields around 3.3%, which is lower than Realty income. But here's where the math gets fascinating. Because of the higher growth rate, a $10,000 investment in Prologis could generate more total dividend income over a 20-year period than the same investment in Realty income, despite starting with a lower yield. Let me model this out. $10,000 invested in Prologis today at a 3.3% yield generates $330 in annual dividends. Not as impressive as Realty income's $550. But if Prologis continues growing dividends at even a conservative 8% annually, which is below their historical average, after 10 years, that annual dividend grows to $712. After 20 years, it reaches $1,537. That's nearly 40% more dividend income than the Realty income scenario. And the share price appreciation potential is even more compelling. Prologis shares have historically appreciated at rates exceeding the broader market because of the structural demand for their properties. If we model even a conservative 6% annual share price appreciation, your $10,000 becomes approximately $32,000 in share value alone after 20 years. Combined with reinvested dividends, we're potentially looking at a total value approaching $65,000 to $70,000. Now, you're probably asking yourself, if Prologis is so great, why not just put all $10,000 there? And this is exactly the question that reveals why most investors underperform. They think about individual investments in isolation rather than as components of a portfolio. Prologis' higher growth comes with higher volatility. During the 2022 market sell-off, Prologis shares dropped over 35% in less than 9 months. Realty income, by comparison, dropped about 20% during the same period. If you had 100% of your REIT allocation in Prologis and you panicked during that drawdown, you would have locked in massive losses. But if you held both Realty Income and Prologis, the stability of Realty Income would have psychologically anchored your portfolio, making it easier to hold through the volatility. This brings me to the third REIT. And honestly, this is the one that most people have never heard of, despite it being one of the highest quality names in the entire sector. Digital Realty Trust, ticker symbol DLR. This company owns and operates data centers. Now, before your eyes glaze over thinking about boring server rooms, let me explain why this might be the single most important real estate sector for the next 30 years. Every text you send, every video you stream, every photo you upload, every search query you make, every AI application you use, all of it depends on data centers. These massive facilities house the servers, storage systems, and networking equipment that power the digital economy. And here's the critical insight. The demand for data center capacity is growing exponentially, not linearly. Think about it. In 2005, the total amount of data created globally was about 130 exabytes. By 2020, that number had exploded to 64 zettabytes, which is roughly 500 times more. And we're only at the beginning. Artificial intelligence, machine learning, autonomous vehicles, virtual reality, the Internet of Things, all of these technologies require massive computing power. They all need data centers. Digital Realty operates over 300 data centers across more than 50 metropolitan areas in 28 countries. Their customer list reads like a who's who of the technology industry. Major cloud providers, social media companies, financial institutions, healthcare organizations, government agencies. These tenants sign incredibly long-term leases, often 10 to 20 years, because moving data center infrastructure is extraordinarily expensive and risky. But here's what makes Digital Realty particularly interesting from an investment perspective. They've positioned themselves as a global platform that can serve multinational customers wherever they need capacity. A company like a major streaming service needs data centers in North America, Europe, Asia, and South America to minimize latency for their global user base. Digital Realty is one of the very few companies that can meet all of those needs with a single relationship. Let me walk through the financial picture. Digital Realty currently yields around 3.5%, similar to Prologis. Their dividend growth has been steady, averaging about 5% annually over the past decade. But here's where it gets interesting. The company is entering what management calls an investment inflection point. They've spent years building out capacity that is now beginning to be leased at attractive rates. Analysts expect funds from operations growth to accelerate significantly over the next several years as these investments begin generating income. The math on a $10,000 investment looks something like this. At a 3.5% yield, you start with $350 in annual dividends. With 5% annual dividend growth, that becomes $570 after 10 years and $928 after 20 years. But if the growth accelerates to 7 or 8%, as some analysts project, those 20-year numbers could approach or exceed $1,200 annually. Share price appreciation potential is also compelling. Digital Realty has historically delivered total returns exceeding the broader REIT market, and the structural demand for data center capacity suggests this could continue. Modeling a conservative 5% annual appreciation, your $10,000 grows to approximately $26,500 in share value after 20 years. Now let me bring all of this together, because the individual numbers, while interesting, don't capture the full picture. Imagine you take that $10,000 and divide it equally among these three REITs. You put $3,333 into Realty Income, $3,333 into Prologis, and $3,334 into Digital Realty. In year one, your total dividend income would be approximately $412. That's about $34 per month. Not exactly life-changing, I know. But here's where the magic of compound growth becomes remarkable. If each REIT delivers dividend growth and share appreciation even close to their historical averages, and you reinvest every single dividend back into buying more shares, after 10 years, your portfolio value would grow to approximately $38,000. and your annual dividend income would approach $1,500. After 20 years, we're looking at a portfolio value potentially exceeding $120,000, generating annual dividend income of over $5,000. That's nearly $450 per month in passive income from a single $10,000 investment made 2 decades earlier. But now you might think, that's great, but I don't have 20 years to wait. And I hear you. But let me challenge that assumption. The average person reading this is probably somewhere between 30 and 55 years old. If you're 35 and you invest $10,000 today, you'll be 55 when this investment potentially reaches that $120,000 mark. You'll still have a decade or more of income generation ahead of you. Plus, that portfolio will likely continue growing. And here's what most people don't consider. This $10,000 investment isn't the end. It's the beginning. If you add just $500 per month to this portfolio over those same 20 years, reinvesting all dividends, you're looking at a portfolio value that could exceed $800,000 to $1 million, depending on market conditions. Let me repeat that because it matters. $10,000 to start, $500 per month added, all dividends reinvested, 20 years of patience. That's the formula that turns working professionals into millionaires without requiring them to pick stocks, time markets, or take excessive risks. This is the game that wealthy families have been playing for generations. They buy quality assets, they hold them forever, they reinvest the income, and they let compound growth do the heavy lifting. The only difference is that you can now play this game with $10,000 instead of $10 million. But I want to be honest with you about something. This strategy requires a psychological shift that most people struggle with. You need to be completely indifferent to short-term price movements. When Prologis dropped 35% in 2022, the correct move was to buy more shares at lower prices, not to panic sell. When Realty income trades down because interest rates spike, that's an opportunity, not a crisis. When Digital Realty faces temporary headwinds from overbuilding in certain markets, that's a chance to accumulate shares at better valuations. The problem is that our brains aren't wired this way. We feel pain from losses roughly twice as intensely as we feel pleasure from gains. This is called loss aversion, and it's the single biggest reason why individual investors underperform. They sell at the bottom because the pain becomes unbearable. Then they miss the recovery because they're too scared to buy back in. The antidote to this psychological trap is having absolute clarity about why you own what you own. When you understand that Realty income collects rent from dollar stores and pharmacies that will keep paying regardless of stock market volatility, you can hold through drawdowns. When you understand that Prologis owns irreplaceable logistics infrastructure in locations where new supply can't be built, you can add to your position when prices fall. When you understand that Digital Realty benefits from exponential data growth that no recession will reverse, you can stay the course when headlines turn scary. This is what separates wealth builders from wealth destroyers. Not intelligence, not timing, not inside information, just clarity and patience. So let me leave you with one specific action step, something you can do today, not someday, but today. Open your brokerage account, or if you don't have one, open one at Fidelity, Schwab, or Vanguard. It takes about 15 minutes. Set up automatic monthly investments of whatever amount you can sustainably commit to. It doesn't have to be $500. It could be $100. It could be $50. The amount matters less than the consistency. Then split those automatic investments among these 3 REITs or others that meet similar quality criteria. Realty income for stability and monthly income. Prologis for growth in the logistics revolution. Digital Realty for exposure to the data center megatrend. Set it. Forget it. Let compound growth work for you while you focus on your career, your family, your life. Don't check the prices every day. Don't panic when markets fall. Don't get greedy when markets rise. Just keep adding, keep reinvesting dividends, and keep holding. In 20 years, You'll look back at this decision as one of the best financial moves you ever made. Not because these specific REITs will be the absolute top performers. I can't guarantee that. But because you'll have built a portfolio of high-quality, income-generating assets that pays you increasing dividends regardless of what happens in the broader economy. That's real wealth. Not lottery tickets, not crypto moonshots, not options trading schemes, just boring,